Here's something most American investors never think about: the stock market you're so loyal to. The S&P 500, the NASDAQ, represents only about 60% of the world's stock market value. That means if you only invest in US companies, you're deliberately ignoring the other 40%. By the end of this video, you'll know exactly whether international exposure belongs in your portfolio and how much is actually optimal for your situation. And here's the thing: this isn't some theoretical debate. Real money rides on this decision. So let's cut through the noise. The first thing to understand is what international ETFs actually give you. When you buy something like the Vanguard Total International Stock ETF, ticker VXUS, you're instantly owning over 7,000 companies across Europe, Asia, Latin America, and everywhere else outside US borders. Apple? Yes, but also ASML in the Netherlands, which makes the machines that literally print the chips inside your phone. Samsung in South Korea, Tencent in China, Toyota in Japan. You're getting industrial exposure, financial exposure, and technology exposure that simply doesn't exist in the same concentration here. Now, here's the easy win. If you're not holding any international stocks right now, even a 10% allocation to something like VXUS or iShares ACWIXUS, ticker IXUS, immediately smooths out your portfolio's performance. Why does that matter? Because human beings are emotional investors. We buy high when markets are roaring and sell low when they crash. It's documented in study after study, including research from Dalbar Associates, which found that the average equity fund investor underperformed the very funds they owned by over 1.5% annually over 20-year periods. Smoother returns mean fewer panic moments. Fewer panic moments mean you actually stay invested. And staying invested, that simple habit, is worth more than any clever stock pick you'll ever make. But that's just the basics. Here's where it gets more interesting. The US stock market has been on an absolute tear since 2010. The S&P 500 returned roughly 14% annually for over a decade. That's not a complaint. That's been wonderful. But history tells a different story when you zoom out. From 2000 through 2009, the S&P 500 returned basically nothing. Negative, actually, when you count inflation. Meanwhile, international developed markets, tracked by the MSCI EAA fee index, returned over 1% per year during that same decade. Not spectacular, but positive. Go back further to the 1970s. US stocks barely budged. International stocks? The MSCI Europe, Australasia, and Far East Index crushed American performance for most of that decade. The pattern is clear. Markets rotate. Leadership changes. What goes up doesn't stay up forever, and what lags doesn't stay behind forever either. This is where valuation enters the conversation, and it's actually your friend when you're thinking about international investing. The cyclically adjusted price-to-earnings ratio, that's the CAPE ratio, measures stock market valuations adjusted for inflation over 10-year earnings cycles. As of early 2024, the US stock market was trading at a CAPE ratio around 30. That's historically expensive. International developed markets, most were trading between 15 and 20. Emerging markets often sat even lower. What does that mean in plain English? It means you're buying future earnings at a discount. It doesn't guarantee better returns next year or even next 3 years. But over 10 to 20-year holding periods, valuation has historically been one of the best predictors of future returns. The academic research backs this up. Names like Andrew Ng at Columbia Business School and his work on factor investing, showing that value and profitability factors work differently across geographies. If this is clicking for you, a quick subscribe helps me keep making these. The best part is coming up next. Okay, here's the one I've been saving. The real case for international diversification isn't about chasing returns. It's about what happens when things go wrong. Correlation. That's the word that matters most. Correlation measures how closely two investments move together. When US stocks drop sharply, international stocks don't always drop the same amount at the same time. Sometimes they even go up. Look at 2022. That was brutal for both US and international stocks. True. But in 2018, when the S&P 500 dropped over 4% in a single day in February, the famous Volmageddon spike, international markets didn't follow lockstep. In 2008, international markets did fall hard alongside the US, but they started recovering at different paces in 2009 and 2010. During the 2020 COVID crash, international markets actually bounced back faster relative to their valuations than US tech-heavy indices did during the initial recovery phase. The point isn't that international stocks protect you from every crisis. The point is that their imperfect correlation with US markets means your total portfolio takes fewer simultaneous hits. That matters more than most people realize when they're actually living through a downturn. And here's the concrete proof. A 60-40 portfolio, 60% stocks, 40% bonds. with 20% of that stock allocation in international stocks historically showed better risk-adjusted returns over rolling 15-year periods than the same portfolio with zero international exposure. Not just better returns per unit of risk taken. That's the number Warren Buffett has cited when discussing why even his own company, Berkshire Hathaway, holds some international investments, though obviously at a much smaller percentage than what makes sense for individual retirement accounts. The research from AQR Capital Management, from JP Morgan's annual guide, from BlackRock's factor studies, they all point in the same direction. Geographic diversification is one of the few free lunches in investing. Let that sink in for a second. A free lunch. In an industry where everyone is trying to sell you something, this one actually works and it costs almost nothing in fees. So there you go. 3 real reasons to consider international ETFs: smoothing your volatility through lower correlation, positioning yourself for leadership rotation when valuations eventually normalize, and giving yourself actual diversification instead of the illusion of it. The specific ETFs to look at are straightforward: FXUS from Vanguard, IXUS from iShares. For emerging markets specifically, VWO or IMG. All of them have expense ratios under 20 basis points. That's less than 0.2% annually, which is dirt cheap for global diversification. The question of how much to hold depends on your situation. If you're early in your career and have 30 plus years, holding 15 to 30% international makes a lot of sense. If you're closer to retirement, you might scale back to 10 or 15%. Enough for diversification, not so much that currency fluctuations create unnecessary noise in your withdrawal phase. The goal isn't to predict which region wins. It's to make sure you're in the game regardless of which region does. If you found this helpful, share it with someone who's only got US stocks in their portfolio and might benefit from thinking bigger. And subscribe. I've got more deep dives on ETF strategies and portfolio construction coming every week. Thanks for watching.